We're going to discuss the various accounting standards as well as the key GAAP assumptions. The following qualitative characteristics are the key to financial reporting. First of all, relevance. The item must have predictive or confirmatory value. Materiality. It's got to be large enough that it could affect a user's decision in the future. Faithful representation indicates an agreement on what a measure actually represents. For example, inventory would not include receivables. That's just not making sense within that category. This also requires our information is complete and free from error. Then we talk about neutrality, which means it implies a freedom from bias. The key constraint here, as we'll see it time and time again in our discussions, is cost-benefit analysis. Hopefully the costs incurred do not outweigh the benefits received in a particular item. In addition to the qualitative characteristics, there are also enhancing characteristics that are somewhat important to reporting. First of all, comparability. We want to be able to compare among different companies and make sure there's consistency in application of these principles. Second, verifiability. That leads to objectivity, where an example would be if we bought a piece of land here in Illinois, we would put that on our balance sheet at its historical cost. I'll get into that topic later in this course, but it's a very sensitive topic on how GAAP differs from IFRS. Next, we have timeliness. The SEC, or Securities and Exchange Commission, that we talked about, requires quarterly as well as annual reports. Those are called 10-Qs on a quarterly basis and a 10-K for an annual report. And lastly, we have understandability. Are the users able to understand the information in our financial statements? So the question is, what are the key GAAP assumptions? First of all, we have economic entity. It presumes that our economic events can be identified specifically with a distinction between the activities of the owners versus the activities of the company. Going concern assumes that a business will operate indefinitely. Next, we have periodicity, which relates to the timeliness. The SEC requires those quarterly and annual reports we talked about earlier. And lastly, in the U.S., for our monetary unit, we use the U.S. dollar. Now let's take a look at the recognition, measurement, and disclosure concepts. Recognition is basically the general criteria for our revenue and expense recognition. Keep in mind, I'll talk about revenue recognition in a lot more detail later in this course. Next, we have measurement. It's based on what the FASB calls a mixed attribute model. Let me talk about this. There's a couple different methods here that include historical cost. Basically, that, as I said with that land example a little bit ago, if something is bought today at $10 million, even if in 20 years it has a, for example, an appraised value of 15 or 20 million, it would still be on our books at the historical cost. That's the conservatism that we use within our GAAP. Second item here is called net realizable value. As we talk about receivables later in the course, we'll understand that we report our receivables at an amount that's the gross amount less than allowance for possible bad debts in the future. We call that net realizable value, or NRV. And then the other concepts here are current cost, present value, and fair value. We'll talk about those. Some of those relate to what we're going to get into a discussion of impairment of assets. Next, we talk about disclosure. Very important issue. One of the reasons why this course has disclosure in its title is it indicates that financial statements should include any information that could affect the decisions of these external users we've talked about, such as the parenthetical comments on the face of a financial statement. Disclosure notes, very important one. For example, Apple, if you look at the most recent 10-K for Apple Inc., they have 25 pages of notes, 5 pages of financial statements.